Hello everyone. Our topic of our presentation is financial instrument options. And let me introduce my group members first. Mine, 忍者, Sand, 四井, and Hidayah. Okay, next we will introduce our topic formally. Next page, please. Next. Okay, firstly, I will introduce what are options. Options are a type of derivative and hence their value depends on the value of an underlying instrument. The underlying instrument can be a stock, but it can also be an index, a currency, a commodity, or any other security. An option contract is a financial contract which gives an investor a right to neither buy, sell an asset at a predetermined price by a specific date. However, it also entails a right to buy, but not an obligation. There are two parties involved. The first one buys holder, the second one seller writer. Next page. Then the types of options, it divided the two types. The first one, call options. Call options gives the call owner the right, but not the obligation to buy a security or any financial instrument at a specific price, or the scale price of the option within a specific time frame. To buy a call option, one needs to pay the price in the form of an option premium. As mentioned, it is upon the discretion of the owner on whether he wants to exercise this option. He can let the option expire if he deems it unprofitable. The seller, on the other hand, is obligated to sell the securities that the buyer desires. In a call option, the losses are limited to the option's premium, while the profits can be unlimited. Next page, please. The second one is put options. Gives the option holder the right to sell an underlying security at a specific strike price within the expiration date. This lets investors lock a minimal price for selling a certain security. Here too, the option holder is under no obligation to exercise the right. In case the market price is higher than the strike price, he can sell the security as the market price and not exercise an option. Okay, next page. Then I will introduce how does options work. If you have bought any security, let us sell stock. You want to sell it at a future date at a high price. To make a profit, you have to buy it at a low price and sell it at a high price. However, since the markets are unpredictable, it is not possible to be sure what the prevalent market price will be. To protect yourself from any position losses, you can buy a put option. This lets you sell a stock at a predetermined right, either before or on the expiration date. Because an options contract does not come with any obligations, it is a kind of insurance. If the price of the stock is indeed lower than the strict price, You can exercise the option and sell your shares at the agreed price that is mentioned on the options contract. By doing so, you make a profit. Next page, please. In another situation, the market price for stocks can be higher than expected, leading up to the expiration date. In that case, the options contract becomes useless as you can directly sell the shares in the market at a higher price. So an options contract provides a sort of protection against the market situation one has no control over. Next page. Okay, this is the end of my part. Let my partner continue to introduce.
So today I'm going to talk about advantages, disadvantages of options and how they are used in the risk management. Options was introduced as a financial instrument since 40 years ago, but it just recently started getting more familiar and receive attention to its benefit and application in the business and trading field, where some of the investors in the past have avoided using options as it was known as a very complicated financial instrument to use, and some of them had very bad experience using an options and incurred some losses. So a number of investors have avoided using options in their trading. And it's also that word of dangerous or the risky has been incorrectly attached to the options through the media or the known figures in the market. But it's very important that for the investors to know the benefit side that he can or she can get from using the options before knowing all the negative side, which will be explained through detailed advantages and disadvantages in the next slides. Can you please next slide? The first advantage of using option is the cost efficiency. Option is featured by having a great leveraging power where the investor, the company can obtain an option position which is very similar to the stock position with a huge saving when it comes to the cost. This can be explained through the example where the investor is going to purchase 200 shares for $80 for each share. In this case, the investor will need to pay $16,000 to have that full 200 shares. But through using an options, the investor will need 20 calls with 2 contracts, and each contract is representing only 100 shares. So the total cost will be $4,000 in comparison to $16,000. So here, the investor will be having another option to invest the difference between these two figures in another stocks, so that he can have a lower risk and improve his risk management. The next advantage is lower risk. Options can be less risky for the investors as they need less financial commitment than equities, and they can also be less risky because of their relative their business potentially catastrophic effects of gap opening. This can be explained through an example of investor APC is buying stock A for $50, but the investor wishes to stop his losses at a certain level, so he uses a stop loss order. So let's assume that the investor is willing to lose 10% of his initial investment, and he places stop loss order on $45, which will become the market order to sell the stock once it reached that level. But the problem with this is it depends on the situation of the market, which means that in case the investor does not physically attend the market or the news about that particular company, there might be a good or bad news about the opening price of that company's share. So if there was like an opening price of $20 of that company share, and the next day the investor comes to the market and check his losses or the profit, he will be surprised by saying the losing amount that he lost, where the amount will be different from the amount that he initially planned to lose in the first place. So in using options, it will be more easier for the companies and traders to hedge against the risk, which make it one of the preferred tool to use in hedging. The third advantage is the more strategic alternative, as Rain mentioned. Yeah, next slide, please. more strategic alternatives. As Rins mentioned about the different strategies where the investor can go long or short when the market is bearish and bullish, and can have different kind of strategies and expiries date and strike prices where he or she can make a profit for the differences between the opening price and the closing price. The fourth advantage is the higher potential returns. The returns in the option trading would be much higher than buying the shares in the cash. As a result of that, the option pays an equal profit as a simple stock buying if I had chosen the right strike. As I have mentioned before, using an options will give the ability to the investor to have to invest or to have the same amount of the shares with a lower capital. As I mentioned before, the $4,000 will generate the same income that the normal investor would pay for the normal shares. As options have different advantages, it also has some coins side which will be explained. Can you go to the previous slide, please? The first disadvantage of using option is lower liquidity, where some stock options have a lower liquidity, which make it very difficult for the trader to make entry and exit from the trades. This results in high spreads between the opening and closing price, which can incur more losses to the investor on both sides of the buying and selling price. The next disadvantage is the commission. Option trading is more expensive as compared to the future or stock trading, where a lot of brokers don't provide the full services for free. So in case for the investor, in order for the investor to purchase or to trade options, he or she will need to pay higher amounts than he needs to pay for investing the stock, the normal stock. The next disadvantage is, next slide, please. Complicated and time decay. When it comes to the use of options or trading it, investors usually get confused of which strategy they use, as it has more options than the normal stock trading. It's also that the value of the option premium decreases by some percentage each day. The fourth disadvantage is the wide fluctuation and uncertainty of gains. As in the option, the investor and the companies are able to leverage their positions much higher than their initial investing account. They might face a risk of losing their old capital with a small wave of, or change in the price of the option stock. And as any other financial instrument, option doesn't assure profit or the gains to the investors and the users of it, where any changes or decreases in the value of the stock, option stock will incur losses to the investor or the user. That's all for my part. I will pass the rest of the slides to my other group members.
So here comes to my part, feature of option. The first one is a highly flexibility and highly standardized, and so they can be traded only in organization exchanges. So such option instrument can be made flexible according to the requirement of the writer as well as the users. In the other hand, there also provide the arranged option which can be traded over the counter. This instrument can be made according to the requirement of the writer and users. Thus, it combines the features of future as well as forward contract. The second one is down payment. The option holder must pay a certain amount according to premium for the holding the right of exercise the option. This considered be the consideration for the contract. If the option holder doesn't exercise his option, he has to forego this premium. Otherwise, the premium will be deducted from the total payment payoff in calculate the net payoff due to the option holder. The third one is settlement. No money or commodity or share is exchanged with the contract is written. Generally, this option contract terminates either at the time of exercise the option by the option holder or maturity, whichever is easier. So settlement is made only when the option holder exercises his option. Suppose that the option is not exercised during the maturity, then the arrangement automatically lapses and no settlement is required. So the next page. The fourth is non-linearity. This means unlike future and forward, the option contract doesn't pose the possibility of the linearity. It means that the option holder the profit when the value of the underlying asset moved in one direction is not equal to this loss when its value moved in the director by the same amount. In short, profit and losses are not symmetrical under an option contract. And the final one is no obligation to buy or sell. In all option contracts, the option holder has a right to buy or sell underlying asset. He can exercise this right at the time during the currency of the contract, but in no case he is under an obligation to buy or sell. If he doesn't buy or sell, the contract will simply lapse. So the next part, Hidayah.
So my part will be discussing on differences between forward contract and also option contract. So for forward contract, both contracting parties are obliged to the transaction, which means one party will deliver the asset and another party will pay for it. While for option contract, transaction only occurs when the owner of the option choose to exercise the contract. So next differences is when the forward contract is created, there will be no money changes in hand. But while for option contracts, when the buyer of the option contract want to gain the rights for the asset, they must pay the seller for the rights. So this payment is called option contract. Next slide. So next, we'll be discussing on hedging with options. So what is hedging? Hedging is a technique that involves the use of financial instruments, which is known as derivatives. So with derivatives, we can develop trading strategies where loss in one investment is offset by a gain in a derivative. So the common two derivatives that is known, which is the options and also the futures. Okay, from the figure below, is showing the differences between the unhedged risk profile and also the hedged risk profile. So based on the hedged risk profile, the firm decides to buy a put option because they wanted to eliminate the downside risk, which is the adverse price movement. But then the firm, however, will have a retain on upside potential, which is the put option is they act as an insurance policy, which means the firm has to pay for it when they wanted to buy the put options. Next. So next is hedging on commodity price risk. So what is commodity price risk? It is a risk of commodity price to change, and it will cause a loss to the buyer or the owner of the commodity. So today there are an increasing numbers of option contracts that are available for the commodities. As an illustration, when a future call option on wheat is exercised, the owner of the option contract will receive futures contract on wheat and the cash payment of the differences between the current future price and also the strike price. Next. Next is hedging exchange rate risk. So mostly companies or firms who are dealing with foreign business partners or collecting foreign currency for exported goods or even paying for imported goods in foreign currency are at risk of loss due to the movement of foreign exchange rates. So firms with this exposure often purchase put options to protect against the adverse change of exchange rates. Next. Okay, the next hedging is the hedging on interest rate risk. So interest rate risk is the potential for investment losses that are results from the change in interest rates. Some interest rate options are options on interest rate. Some interest rate options are options on interest-bearing assets, such as bonds. As an illustration, for example, if we want to protect the increase in exchange rate, so we have to buy options that are increase in value when the interest rate increases. So as the interest rate increases, bond value decreases, hence buying put option is the way to go. Next is the types of interest rate option. So the first type is the interest rate cap. So interest rate cap is the call option on interest rate. So this is usually for firms that worries on the sharp rise of the interest rate because it will increase their loan payment. So when firm purchases interest rate cap from the bank, and then if the loan payment increases due to the increase in interest rate, which is above the agreed limit, which is the ceiling, the bank will pay the differences between the actual payment and also the ceiling. Another one is the floor. So a floor is a put option on an interest rate, which is the firm will sell put and also buy call. This will protect the firm by increase. This will protect the firm by when the interest rate increases above the ceiling rate, or maybe it drops below floor rates, the firm will pay in between the floor and the ceiling. Okay. So next interest rate option is swaption. So for swaption occurs when usually on the case of floating rate loans. So when the firm buys option on swap, they wanted to swap a floating rate loan to a fixed loan sometimes in the future. So next is caption, which is also known as compound options. So if the firm plans to buy a caption in the future, then they will buy an option on cap. So the cap is the interest rate. The cap is option on interest rate. Sorry. Okay, next I will pass to Sijin to discuss on the case study.
Thank you, Hidayat. So here comes to the case study. So I just find an article discuss the application of a 3-option strategy in practice by taking selling the weight as an example. In this case, Mavet put option contract at a strike price 5.8 bushel. One event option contract size is 5,000 bushels, and we can see from the right chart, call option premium is 1.074, and the put option premium per share is 0.171. So the next. Okay, the first one is a long put strategy. This is a simple bear strategy. By buying put option, the producer has the right but not obligation to sell a future commodity contract at a strike price X at the time T with a specific time period. For this right, the producer has to pay an option premium PL. For an option buyer, the premium represent the maximum cost or amount that can be lost, since the option buyer is limited only to the initial investment. So we can see from the picture, if the stock market price ST is below the 5.629, the seller will receive a maximum selling price. That is option strike minus the premium paid for the option, 0.171. In this case, the hedging strategy is profitable. We can see from the picture that the market price in the other case. So I'm not going to elaborate on it. So the second one is. So the second one is long compound strategy. Long compound strategy is formed by buying a put option with a lower strike price X1 and an option premium P1, and at the same by selling a call option on the same future commodity contract with a higher strike price X2 and an option price premium CS2. And long compound strategy is also called the zero cost long compound strategy. It eliminates the price level risk if the market moves downside, and by this strategy, the commodity seller establish a higher floor price level, but limited the opportunity of the higher price by establish a selling. So the next. The last one is the inverse vertical ratio put spread strategy. Is a spread option strategy formed by buying a higher number of put option N1 with a lower strike price X1 and option premium P1, and at the same by selling a lower number of the put option N2 on the same commodity with a strike price X2, maturity T, and an option premium PS2, and the inverse vertical ratio put spread strategy enable to hedge a low price level and at the same time to participate in the price increase. The selling price range by the inverse vertical ratio put spread strategy is not only determined by the strike price, it's also determined by the number of the option. The greater ratio of the number of options, the higher the flow selling the price. So it's come to the conclusion.
Okay. As a conclusion, just to recap on the whole presentation, an option is an agreement that gives the owner the right, but not the obligation, whether they wanted to buy or to sell a specific asset at a specific price for a set period of time. So option is also a part of financial risk management tool, especially on commodity, exchange rate, and also interest rate. It is widely used by various types of firm and also individuals. That's all from us. Thank you for listening.
Thank you.
Thank you. Thank you.
Thank you. Okay, done.
Okay.